How we doing? You guys surviving over there?
Yeah, yeah.
Is Kate getting good at pool?
No, she gave up after a while.
Oh,
But I'm getting good at gardening and digging up tree roots. Getting really good at that.
well, I'll tell you what, the Garmin family is, our ping pong battles have gotten to be quite epic. Everyone in our family has gotten super skillful at the game, which is pretty So 11:01, I'll go ahead and get started. Hi, everybody. It's Don and Jonathan here from Mirador Capital Partners. And as promised, we're going to do a little back and forth here. Obviously, we just wrapped up our investment committee. I'm giving myself yet another W in the W column for the greenness of the screen, even bonus points because the market's red. It's double good. But I thought Jonathan and I would come and just give you a little chat about some of the things from a fundamental perspective that are on our mind that keep us oriented more toward a little bit of a defense rather than sort of getting really excited about a V-shaped recovery and going more offensive. But before that, for those of our clients who haven't had a chance to meet Jonathan, he's been with us now a couple years, JT, or
2 years, a little over 2 years.
Little over 2 years. So for our clients who haven't met you in person or had the benefit of being in a meeting with you, give us a little bit about your background, kind of what led you into Mirador?
Yeah, I'd love to. And I apologize, I probably should have done this in my first video. People were probably like, who is this guy? Yeah. But it's nice to meet everybody again. My name is Jonathan Ting. And my background, I graduated from Purdue University in 2013. And I studied public health and environmental health sciences at the time. I wanted to work for the CDC or the WHO. And then I was joking with my wife last week. I was like, oh my God, thank God, otherwise I'd probably be in Wuhan right now. So that's what I did. But after I came out of college, my first job took a quick turn, and I actually moved over to Shanghai to work at an IT outsourcing, project outsourcing firm over there, doing business development and project management. So I was there for about 2 to 3 years. I met my wife there, but it was also there at the same time where I realized pretty quickly that building the next iPhone or building the next tablet was really cool. We'll buy it. But really what drives that entire industry and what drives the world is capital. And you need capital investments behind anything to change the world. I realized that pretty quick. So I realized that's the side of the business I want to be on, not necessarily building the projects. So when I moved back to the US in 2015, I think, I started working at a small investment banking, merchant banking firm where in San Jose, we would invest in companies, we would try to sit on a transaction, and we would also consult to help the business owner grow their business specifically for companies in the mid-market to lower mid-market software and IT services segment. So I did that for a while, and then I found you and Greg. So I've been with you guys for the past 2 years, and it's been wonderful. Yeah.
So I'll out you by saying that what tipped the scales for Jonathan and why Lauren and I were so impressed with him as a candidate before we offered him a job was, as we explained our thesis, and Mirador, we have a particular point of view about the Tri-Valley and where it fits in the next 2 decades, in the context of the Bay Area and world. And Jonathan understood that immediately. And even before we had offered him the role, he was creating the research on his own. And so by the time we were going through the interview process, he would bring in these completed, research pieces on companies that we were following or that we owned. So it was one of those great stories of he was already doing the work before he was getting paid for it. So it made him an incredible, obvious choice.
I got to say this. I don't know if I ever told you, but when I was interviewing, I went back home one day and I told my mom, I was like, Mom, there's this firm and he's got this idea of the Tri-Valley and they're going to build this index and they're going to, that's going to be the focus area because it's just like, that guy knows what he's doing. So it wasn't just me.
Love it. Well, I'll tell you what, buddy, it's been an incredible pleasure working with you. For those of you who don't know, Jonathan brought me to China for my first time last October. So we might have been the last ones to get in and out before the world changed and got really weird. And then for those of you who also don't know, Jonathan runs our aggressive growth strategy, which is the one that's over here. Many of you own it. It's actually up on the year, which is incredible. So before we get into anything more, I want you to describe. Markets have been challenging. It's been a weird year with a once in a century pandemic.
Definitely.
You have been up in an equity aggressive strategy without owning the 5 biggest market cap stocks in the world that are dragging the S&P 500 forward. So how do you give us a little insight into how you have done that, and doing it with as little raw long exposure as you've done is very impressive. So share some of the thought process.
Right. Well, I think the clients that have been with MAGS for a while have seen his ups and downs. I mean, when I first took over MAGS, very quickly, I mean, I think we were beating our benchmark by like 20%, and within the next month, we were flat on the benchmark. So there are volatile times in the position. The way I think about MAGS is it's a small cap tilted product. So we're trying to invest in companies that are under $20 billion in market cap, maybe even less than 10. We're looking for companies that are under coveraged, so people aren't really looking at them. They're not really trading, which makes the gap between their actual value and their trading value very wide. And when we see a wide gap, we try to take advantage of it, and we get it. We'll ride the volatility for a couple of years, and hopefully those companies will come out. So a lot of these small cap picks have been very well. We're highly focused in the software sector, specifically cybersecurity, which has done very well. We're trying to invest in companies that carry little to no debt. We do have a couple of companies in there that do have debt, but we do, like bottoms up, look at their financials to see, okay, this is temporary and they have inflection points in the future. So it's been working out well. I would say for the outperformance this year, we've been moving into this year pretty conservatively in all our strategies, and been talking about that in our previous videos and letters. So we were positioned well for what came, and we've just been getting a little bit more defensive from a broader standpoint, but our individual picks have really been doing quite well this year, which I think has helped bring the strategy up. So that's nice, and hopefully we can continue that.
Okay, good. So for our clients will know this, which is I think you're getting ready to put out a blog pretty soon, maybe even later today, talking about.
We'll send it out with the video, I think.
Okay, good. So talking about some of the disconnects, right? So I referenced this earlier, the Economist magazine from this week. The headline is "A Dangerous Gap: The Markets versus the Real Economy." So I know some of these things have been on your mind as well. Why don't you talk about some of the data that you're looking at that gives us the conviction in maintaining a defensive posture?
Right. I think the divergence really started last year. Even it wasn't really this year. It's just that earnings from last year were held up by stock buybacks, which made the economy look better than it was. But unemployment was going up. I mean, global trade was falling. Manufacturing industry was already going through a recession. Corporate debt was at an all-time high. I mean, there are many things we could point to. This time specifically, the divergence is getting even wider, and it's getting dangerously wide in my view. So if we look at all the key indicators that economists and analysts typically look at to evaluate the market from a broad standpoint, for example, if you look at industrial production profits, right? Profits that come out of the industrial and manufacturing sector. Those, if you look on like a 50-year history, they just track the S&P 1 for 1, right? And now they look like this.
Yeah, alligator jaws.
Right, and there's alligator jaws in the ISM, which typically track earnings 1 to 1, and now they just look like this. And you have corporate earnings that are falling, still in free fall. I mean, last Friday when I looked, 2020 earnings growth was negative 19.9, and I look today and it's negative 20.6. So who's to say it's not going to go to negative 21 next week? And we're pricing in a rebound in Q4. If you look at the earnings, we get a bounce in Q3 to Q4. But You know, and global trade still never recovered from the March levels, although the stock market did. And you know, the blog post that I put out talks about the New York Fed doing a survey for the month of April. They surveyed 1,300 family and households in the U.S. and they asked them a bunch of questions about what they feel about the future. And it was very interesting, this report. They asked them about their personal lives and their jobs, things like, what do you feel is the chance you will lose your job over the next 12 months? And a lot of people were like, okay, the chance is very high. What is the chance that you will make less income next year? A lot of people are answering, oh, the chance is very high. What is the chance that you will default on a loan? A lot more people are saying, I have a higher chance of defaulting on a loan than in the past. But at the same time, they asked them, what are the chances you think the stock market will be higher in the next 6 to 12 months? And I think in January, only 30% said yes. And as of April, I think about 60% said yes. So a lot of people are getting very bullish, right? And we're also seeing a divergence in the kind of people who are getting bullish. A lot of retail investors are getting bullish. A lot of these consumer surveys are showing that normal household average Joes are getting bullish on this market and want to get in on the run. Meanwhile, a lot of big money managers, you know, hedge funds, global macro funds, mutual funds, they have not been partaking in this rally, which is very interesting. So somebody's right and somebody's wrong. You know, we'll see how that plays out.
Yeah, I think that's well said. So, what would be your path to getting more constructive? Is it time? Is it price? How do you envision moving from a defensive posture to one where you can feel a little bit more comfortable?
Right. So I'll speak for MAGS specifically. We have a lot of cash in MAGS we're holding as dry powder to deploy when the time is right. And we have a significant short position that we will unwind when the time is right. I wouldn't say necessarily it's price. Of course, I look at the price on the S&P 500 and we're not yet at like the all-time high it was in February, but on a valuation basis, we're
stocks are more expensive.
Yeah, it's more. The S&P 500 is more expensive today than it was at the peak.
Yeah.
So price is not necessarily the indicator. I did know some indicators in the first video I said when corporations start giving out guidance. So far in the companies that have reported in the S&P 500, about 80% of them have not given guidance. You know, versus 80% of them giving guidance last year, which is crazy. Yeah. We hope to see, you know, surveys in the consumer actual spending patterns come back. You know, we'll see how the virus plays out. But I will say that we are entering a very interesting time with the Fed stepping in. They stepped in at the bottom of this crash and they've just been driving this thing higher.
Yeah.
And the question is, are they going to be enough to support this economy? And you ask different people and you will get different answers. But one thing I think that nobody knows, and I think many investors agree with that standpoint. If you look at Warren Buffett, there's a reason why he didn't deploy his capital when things came down, is because he doesn't know too. And he's also said this is going to be an experiment and we don't know how this is going to end. Yeah. So the way I see it is I don't mind if the market goes up another 15%. I don't mind missing out on that to make sure that there's some stability in what's going on and that these prices actually reflect what's going on in real life.
Yeah.
I'll give you a quick example. Sorry, I have to put this in. Is that right now I think what's going on is somebody is showing up at my house, okay, and offering me $7 million for it. The house is not worth that much. Stocks are not worth where they are today. But somebody is offering $7 million and a lot of people are selling their houses. And then next week, my neighbor just sells his house for $8 million. So what should I do in this case? Should I go out and buy my neighbor's house for $8 million and try to flip it for $9 million? For me, the answer is no. I'm just going to sell my house at $8 million. And if somebody can sell it for $10 million, I'm going to let him take that extra $2 million because I don't want to risk it.
Yeah.
So that's the way I'm sort of seeing it at the moment. There's still a lot of risk to the downside in the future. And we want to see how those play out before we really get back in.
Yeah, I think that's a fair sentiment. So I think for the purposes of today, I think we can leave it at that. Is there anything else you wanted to add?
I would just like to add that you know, if you're looking at the stock market every day going up, I wouldn't be completely fooled that this is the return and we are in a recovery. Price doesn't necessarily reflect what's actually going on, and this could possibly just be a bear market rally. It's not out of the
I mean, it could be that things went too far too fast on the downside. I think you said this to me yesterday, you know, in March, and then the Fed stabilized the system and we could be just bouncing back. I mean, let's not forget the small cap index is still down over 20% year to date. The S&P 500 is still down 10.
Yeah, 80% of the companies in the S&P are still below their 200-day moving average.
Yeah, well. So there's a lot of damage underneath. So I think all of that leads us to continue to keep defense present, continue to view this as a very long-term proposition, and you know, not one where we want to be too far on either end of the teeter-totter, right? And sort of keep it in the middle if we can.
Yeah.
So on that note, we will leave you and we will check in again on Friday and recap the week. So far, so good. And Jonathan, thank you for all you're doing, and to the Mirador team. And for those of you who are interested, the beard did not survive Mother's Day. It was the greatest gift you can give the mother of your children on Mother's Day is a different look when you're in quarantine. So I gave her, my wife and daughter, a little different look for the day of Mother's Day, but it's going to creep back over the next several weeks. So anyway, we'll leave it there for now. Thank you, Jonathan, and we'll talk to everybody soon.
Thank you, Don.